In finance, we're very interested in understanding the role that risk and attitudes to risk play in determining investment behavior, which is obviously very important for long-run economic growth. My co-author Pavel Savor and I were particularly interested in understanding the role that marital status and changes to marital status over an individual's life can affect important risk-taking decisions. Generally, marital status is not something that is thought of as an important determinant of economic decisions and risk-taking decisions in particular. However, there are reasons shaped by both economic and psychological forces to think that it may indeed be important. What we wanted to know is it important for decisions that are really large stakes outcomes that are tied to them? So what we look at is the risk-taking decisions of CEOs of public companies in the U.S. So we collected data on marital status of CEOs of 1,500 largest public companies and looked at the differences in behavior of these firms, of the firms that were led by CEOs who were single and those who were married. What we found was that firms led by single CEOs engaged in much more aggressive investment behavior along the lines of capital expenditure as well as innovation activity, research and development, acquisitions to some extent, than companies led by CEOs who were married. And these differences translated also in greater riskiness of the firms led by single CEOs as measured by the stock return volatility. What was surprising to us was how large the magnitudes of these differences were. What we found was that, not accounting for various differences between the two types of firms, you could see that firms led by single CEOs invest almost 75% more as a kind of share of their current assets in the various firm-building activities, such as, again, capital expenditures or research and development. Now, part of that difference is attributable to the fact that the firms that single CEOs run tend to be smaller, younger firms. These tend to grow faster and therefore invest more. However, even after accounting for the variety of differences in these two types of firms that we can observe, we find that there is a still sizable difference, about 10% greater investment by firms led by single CEOs compared to firms run by CEOs who are married. And differences in stock return volatility are also quite substantial. Well, the key practical implication is that a person's individual characteristics and person's individual kind of life cycle matter for the decisions that they make on behalf not just of their families themselves, but also on behalf of the firms that they lead. And therefore, one may need to be aware of the personal situation that a leader of a company or a manager has, because that is going to shape the risk-taking decisions and investment decisions that they're going to be facing. One reason to believe that marital status shapes risk-taking decisions has to do with kind of the economics of marriage. And what this means is that single individuals, they're clearly competing for potential mates with other single individuals. And one of the important factors in that competition is kind of socioeconomic status. And even at the kind of the high end of the wealth distribution, where most of the CEOs are, how much wealth you have, how successful you are, matters potentially for your prospects. And that potentially could be one of the drivers. Another potential driver is, of course, that people who are kind of married, have a family, they're more risk-averse simply because they have a family to provide for, and they're just more cautious and more careful. We're not sure if that is as important enough of a concern for the wealthy individuals that CEOs tend to be, but it's a potential concern. Something that is kind of in between is kind of psychological, almost evolutionary biology shaped driver. There's evidence, in fact, in evolutionary biology that suggests that single men in particular are kind of more aggressive and are willing to take more risk. And that may be related to some extent to our kind of status story, but it could be a kind of a purely biological driver that we're not able, of course, to identify. It's an interesting question how much boards can actually take into account the manager's kind of personal life circumstances in hiring or firing them, and to some extent that is not entirely legal to do so. However, in determining the compensation package that the CEO will receive, in particular how much incentive compensation to award the CEO, for example, in the form of options, clearly it matters how risk tolerant or risk averse the CEO is. And therefore, knowing their personal situation, knowing something about their marital status, whether they are indeed in the search for a spouse or not, may impact how sensitive that compensation package that the CEO will receive is to the performance of the firm, and therefore how much the firm wants to encourage the CEO to take more or less risk. Because a married CEO who is leading a fast-growing firm may be potentially overly cautious, and we may need to incentivize them with, in particular, options to take more risk. On the other hand, you could have a young single CEO of a firm whose investment opportunities are not that great, and the firm that needs to grow in kind of a more conservative fashion. There, you may want to scale down the risk appetites of the CEO by appropriately shaping their pay package. I think these results have potentially very wide applicability throughout the business world. We focused on the CEOs because this is one of the settings where the stakes are potentially as large as they can get, and finding an effect there in some sense is the most surprising. However, we can think of managers, of course, at lower levels who still make risk-taking decisions. We can think of course, the money management industry where risk is everything. And risk-taking decisions are very central. In the money management industry, the trade-off between risk and return is the key determinant of success, and therefore we should expect the same type of forces acting there as well. I think there is potentially misconception that actually economists help perpetuate that managers are kind of like automatons and machines that do the right thing. They're the rational maximizers of something. The question is what that something is, of course. And what we're adding to this picture is that managerial decisions are affected by what is happening in those individuals' personal lives in ways that most of our views of kind of business decision-making does not account for. Well, nobody, of course, has looked at the effect of marital status on the decisions of CEOs, but there's a large field of study that tries to understand the role of CEO characteristics in driving firm outcomes. What I think is particularly important about our approach is that we're looking at a characteristic that is not an inherent personal trait of an individual, like some life experience they obtain early in their life, or some particular kind of immutable thing like race or gender. What we are interested in how in a characteristic that is inherently changing over time is affecting individuals' behavior. Now, one could say that what we observe in the data is that there are some individuals who are inherently more risk tolerant, that they also tend to be more likely to stay single, and then there are others who are somehow more conservative, and they're also more likely to be married. We would like to rule out that simple explanation for our story. In order to do so, we look at predictors of marital status that allow us to identify the effect of the changing marital status rather than a personal kind of inherent trait. What we look at is the variation in the laws governing divorce across the states in the U.S. And the idea is divorce laws shape the incentives to get married, especially for wealthy individuals. In particular, in community property states, it is much costlier for a wealthy individual to be divorced. Therefore, it is potentially costlier for them to get married in the first place. And all else equal, that will shape the decision whether to get married or not for a particular person. What we find is that in community property states, where indeed the CEOs are more likely to be single, as this logic predicts, CEOs are also kind of more risk-taking and more willing to invest in the firm and take greater risks, suggesting that the evidence that we find is not about kind of the two different types of people, but more about how these marital incentives are driving individual risk-taking decisions. Well, one interesting direction that I sort of alluded to earlier is to see how does marital status affect risk-taking decisions of money managers, hedge fund managers, mutual fund managers, individuals who make risk-taking decisions, again, on a daily basis for potentially even more responsive to kind of risk and return trade-off. And that's something that is definitely in our agenda going forward.